even the more optimistic forecasts that say we might get up to 3.5%. If you grew at 3.5%, as I say, starting in the middle of 2011, you would not get back up to the blue line until 2015. All right, so that means that you could be at an unemployment rate that will be above what you think is full unemployment, which is somewhere around 5.5% for some time. So and that has occurred despite the fact that monetary policy in a lot of it across the board has been very, very accommodative. So this is similar to a chart you saw earlier. The blue line corresponds to the policy instrument for the Fed. That's going to be the Fed funds rate. So you saw that line earlier. The other lines are the similar policy instruments for the other two central banks, the other three, the ECB, the Bank of Japan, and the Bank of England. You can see what they've all done is lower the this policy rate to near zero, essentially pushing. This is about as much as you can do to push short-term interest rates down. Now, one other thing to note here about this is if you look at the timing in these, if you look at the blue line versus these two lines, you'll notice that the U.S. moved much, much earlier. And so when you read the paper and you see these difference of opinion, say, between the ECB and the Federal Reserve on views about monetary policy going forward, part of that reflects a philosophy that from Ben Bernanke, the chairman, that you need to be aggressive when you have this kind of a financial crisis. It's a commitment not to make the same mistakes that were made in the Great Depression and to some extent by the Bank of Japan in the 1990s. So very, very aggressive early on, and that difference in aggressiveness is going to be reflected even in his policy as we move forward. But the point is that we've done as much as you can possibly do for short-term rates, and so you hear about, it was referred to earlier about quantitative easing. The way we refer to it is large-scale asset purchases, and that is to try to distinguish it from some earlier policy actions that were taken, say, in the 1990s by the Bank of Japan. What you've done is shift, since you've done as much as you can possibly do for short-term rates, the alternative is to move to try to affect intermediate and long-term rates. And so if you look at this chart here, it shows the balance sheet for the Federal Reserve. And the part to focus on is the light blue and the rust color. What those represent is the purchases of long-term securities, basically Treasury securities and the securities of Fannie Mae, Freddie Mac, and Ginnie Mae. And so far, the commitment, earlier commitment was $1.7 trillion in those long-term securities. What was the goal? The goal was, since you've done all you can for short rates, this was an attempt to move to affect longer-term rates. The estimates of what the impact would have been is about a 1 percentage point on long-term rates as a result of this. Now, the more recent move is beyond this chart here. If you come back in 8 months, you'd see another $600 billion in long-term Treasury. So the most recent Federal Reserve policy statement just a week ago was to further the asset purchases another $600 billion. The goal there is to affect longer-term rates. The other message that gives, though, to the market was that the Federal Reserve thinks that there's still need for additional stimulus, additional accommodation. So there's two things happen here, though. It affects long rates, but it also affects the market's view of when the Fed might raise the short-term rates also. And so this next chart shows the various interest rates, and the longer-term rates are here. But what I want to do is have you focus on these two bottom lines. The black line there is the federal funds rate. So that's the overnight rate that banks charge each other, and that's the main rate that the Federal Reserve affects. The red line there is the one-year Treasury rate. So they're the same. So what does that tell you? So if you know anything about interest rates, what are interest rates? Well, interest rates, a one-year rate should be the average of what people think interest rates are going to be for that next year. 2 years, well, if the one-year rate is the same as the overnight rate. That tells you that they don't think it's going up. All right. So that's what the market's saying, and we heard even further out forecast. Luckily, I don't do forecasts on interest rates. So, but the market does. All right. So what that says is that you're going to have an accommodation for a considerable period of time. The language that the Federal Reserve uses is extended period. So let me just finish up with one last slide, because this is an issue that will come up in this global context and in this debate about policy more recently, and that is what's going on with exchange rate. We've heard about currency wars and these sort of things, and it's good press, but I think in these international debates, everyone's always saying you ought to be doing something else different than you're doing because it would be good for me. But the reason I put this up here was just to put this exchange rate story in perspective. Okay, so the blue, black, and red lines are long-term interest rates and for the different countries. But the green line there is the one you want to look at, and that is that's an index of the value of the dollar against a number of different currencies of our major trade partners. So the first thing you should notice here is the decline in the dollar really was going on well before the crisis. And so this issue about the value of the dollar is going down and what the implications that are, we really had it went up sharply and it came down. What happened during the financial crisis, which is beginning right about there, what's happening in the financial crisis was that there was a flight to quality. And so the movement up in the value of the dollar really was part of the financial crisis when people were moving back into the U.S. as a safe currency. When did they start feeling a little better about things? Well, you can see. You know, the financial crisis, and that earlier you saw those exchange rates, those risk premium coming down. People were feeling more comfortable. Well, what they get nervous about again? Well, we heard about that. That's the European sovereign debt problem. Well, it looks like the market's also feeling a little better about that. But the point of this chart, if you can see, is that if you go back to the beginning of the crisis, and this is not for every currency, but if you go across a set of currencies, the value of the dollar today is about the same as it was, weighted by these trade about various different parts, about where it was in the beginning of the crisis. And that was at the end of a long period of declining. The other thing I'll say is that discussion about the recent policy actions of the Fed in terms of buying the additional $600 billion in Treasury securities is that all the analysis so far that the effects of that are seen right away. So what happens which is different than some other policies, when the Fed says they're going to buy $600 billion in Treasuries, the market essentially moves right away because they anticipate that. And so in some sense, whatever effect you're going to have from that announcement, even though it will take time to do that over the next 8 months, it's already baked into the numbers. If the dollar moves after this, it could move up, it could move down for various reasons. But if it does, it won't be because of this most recent move. It'll have to be new statements or new developments. Let me stop there. Just one last thing you can look at, and that is if you your stock portfolio was looking bad, and I'm sure it's looking better no matter where you had it. Although Japan looks to be the one that you should have tried to avoid. But obviously, the global financial crisis affected across the board, but we've clearly had sharper rebounds in the BRICS, in Asia, and in Brazil. Compared to the others. The S&P and the rest are still not back up to where they were prior to the crisis. Thank you.